Hey guys, welcome back to another episode. In this presentation, I'm going to show you the basic technical analysis concept every trader should know. This is a journal that I made for myself when I started trading, and it has helped me a great deal in navigating the financial market. The concept that I will show you in this video applies to forex, stock, and the crypto market. Here is what we are going to cover in this video. First, we will look at candlestick charts, then trend, and then break of structure, and then trend line. Then we look at supply and demand, chart patterns, break and retest, and then candlestick patterns. So this is going to be a long hours lectures. So let's jump right into it. So the very first thing we'll start with is candlestick charts. Most people don't understand that the foundation to understanding price action starts with candlestick. Without a proper knowledge on candlestick and how they are formed and their patterns, you can't read the prices, you can't read the chart correctly. So first we have two kinds of candlestick. We have the bullish candlestick and we have the bearish candlesticks. Now the difference between the bullish and the bearish is in the open and close. The bullish candlestick opens below and closes above, while the bearish candlestick opens above and closes below. That is the major difference. The open and the close positions in the two candlestick varies. The bullish candlestick signifies an uptrend market, while the bearish candlestick signifies a downtrend market. That's why the bullish candlestick opens below, starting low, and then closes high up, while the bearish candlestick opens high up, bringing price down, hence the name bearish, while here we have bullish. Now another name for the bullish candlestick, we can call it rising candlestick, while another name for the bearish candlestick, we can call it falling candlestick. Means that price is trending downward, while this signifies that price is trending upward. Now there are major parts of this candlestick that we have to always take note of, which is the high and the low. The high is the highest point that the price or the candlestick got to, while the low is the lowest point it got to before closing. The close point is the last point the candlestick ended. Remember that each of these candlesticks represents a time frame on the chart. So a 5 minute candlestick represents 5 minutes time frame on the chart. So if you're on the 5 minutes time frame, you are looking at 5 minute candlestick. What that means is that it takes 5 minutes for each of these candlesticks to be complete or completely formed on the chart. So this, suppose this was an hour candlestick, 1 hour candlestick. It means that it took a whole 1 hour for this candlestick to be formed. So that means that this candlestick may have opened here, came down, went up again, and then came back and closes here. This green body here is what we call the body. This green part here is what we call the body. This little low here is what we call the wick. And then this is the high. Same thing applicable here. The red here is the body. The long black here is the wicks. They are the wicks. And then we have the open here and the close. This is the highest point this bearish candlestick got to before trending down, and this is the lowest point it got to before closing up here. This wicks here shows the point it got to. So the candlestick has the open, the close, the body, the high, and the low. Those are the major components of candlestick that we should be conversant with, that any trader should be conversant with if you are going to read the chart correctly. We have the bullish candlestick, like I said, and the bearish candlestick. Bullish signifying uptrend and bearish signifying downtrend. Those are the basic things that we need to understand on candlestick. Now, each of these candlesticks, like I said, they represent the time frame on which you are on. That means that a 1 month time frame means that each of those candlesticks took a whole 1 month for it to be fully formed. So suppose this was a 1 month candlestick, it means that it took 20 trading days to form one of these candlesticks. So candlesticks are very important in the market. Understanding them shows that you understand how prices are formed in the market. Now, A bearish candlestick does not mean that the candlestick just started and it was bearish throughout. There may have been a point where this candlestick was bullish. That's where you have this wick here. So it may have opened here, went up here as a bullish candlestick, came back again due to selling pressure. And then due to the selling pressure, price dropped down, got to this point again. Due to buying pressure, they push it up and close it here. But this shows that it is a bearish candlestick. So understanding this basic of candlestick anatomy is very important to reading price action. Now let's look at uptrend and downtrend market. Starting with uptrend. Uptrend means that price is rising. So here you can see we have the bullish candlestick, more of it. Because the bullish candlestick signifies a rising market, this we have an uptrend market. And so we have more of bullish candlestick than they are bearish candlestick. So that's why price is going up. And so in an uptrend market, there is something that is very, very unique that we always have to know, which is the structure. Here, price was forming higher highs, higher lows, higher highs, higher lows, higher highs, higher lows continuously, showing that it is an uptrend market. And so while the bullish candlesticks were more in this trend, we are looking at the structure of the market, which is very important. So this structure tells us the trend of the market. Remember, for you to be safe, for you to make money in the financial market, you always have to trade in line with the trend of the market. And so the trend of the market is uptrend. How do we know? Because price is simply rising. How again do we know? Because there are more bullish candlesticks than there are bearish candlestick. How again do we know? Because the structure of the market is making highs and lows, more highs than lows. So we have longer highs and shorter lows, longer highs and shorter lows, longer highs and shorter lows. So because we have more of higher highs being longer than higher lows, we know that it's an uptrend market. And it's a very simple way is that it's just going up. So because price is just going up, we know that it's an uptrend market. Next is the downtrend market. Downtrend market simply shows that price is falling. And so in a downtrend market, we are looking for sells alone. We are looking to sell in a downtrend market. And so we have price coming down, lower lows, lower highs, lower lows, lower highs, lower lows, lower highs. So we have price falling. And because there are more bearish candlestick in this downtrend structure, we know that price is trending downtrend. And because price is trending downtrend, we want to do what? We want to sell. So in a downtrend market, we are looking for sells. Meanwhile, in an uptrend market here, we are looking to buy. The next thing is a break of structure. Break of structure means that when price has changed trend from maybe an uptrend to a downtrend, or from a downtrend to an uptrend. So here we have price was trending down, forming lower lows, lower highs, lower lows, lower highs, lower lows, and then price reversed back, trying to form a lower high but broke previous lower high. So when price broke this previous lower high, we know that price has broken the structure. We call it distorted structure. And so we are looking for an opposite trend. And so what happens? Price has to come back to retest that broken points to confirm this new trend and then started trending uptrend. And so remember, in an uptrend market, price will start forming higher highs, higher lows, higher highs, higher lows continuously again. But the most important thing to look at is that structure was distorted here. And so when price closes above the previous lower high, it means that the structure has been broken in a downtrend. And when price closes above or below the previous higher low, it means that price or structure has been broken in an uptrend. So whenever price comes back to close below this lower high here, we can say that structure of the market has been broken. Let's go back to an uptrend market so that we have a classical example. And so this is a lower high point. So assuming this price had come back to close below this lower high, we would have said that price or structure of the market is distorted, that the structure has been broken to downtrend, and we'll start looking for sales opportunity. Remember, to make money in the financial market, you have to always flow with the trend of the market. You cannot be wrong trading in line with the trend. You can start seeing errors and failures and losses in the market when you start trading against the trend of the market. And so break of structure is change in direction of the trend. So structure price of the market was trending uptrend, price broke and started going downtrend. And so at any point when price is going to change the trend is when we witness a break of structure. Another thing that is very important that we use to track trend line is to track trend of the market is trend line. Trend line joins projections in the market. In an uptrend market, we have trend line joining higher low points in the market, showing that the trend is being maintained. Remember, in an uptrend market, the most important points are the higher lows. Why? Because at any point where price closes below the previous higher low, it means that the structure is being broken. And so here we have higher highs, higher lows, higher highs, higher lows, higher highs, higher lows continuously. So to draw a trend line, we drag it from the first projection to the body of the second projection and drag into the future. And so how do most people trade this pattern, this trend line? They trade it when price comes back to tap into the trend line again. So at the retest, at the touching the third time on the trend line is where people look forward to taking trade and flowing with the direction of the market. And so this was the first projection. This was the second projection. This is the second touch. And then we draw this trend line from the first projection to the body of this second projection and then drag into the future. And when price came back to tap in, then we take our buy and flow with the trend. This is a downtrend trend line also. We have the first projection here, we have the second projection here, and we drag into the future. That is how to draw trend line. And so trend line helps us to know the trend of the market, to confirm the trend of the market. Remember, in a downtrend, we have more of bearish candlesticks. And so we have more of bearish candlesticks here because it is a downtrend market. And so price tapped in here the second time, and then we drew our trend line, showing that the trend is going downtrend. Another thing that is very important that we should know in technical analysis is supply and demand. Supply and demand is very, very important. Supply is when we sell at a point that we thought most price was going to reverse from. And demand is like, let's see, supply is like a resistance and demand is like a support. Supply is like a zinc, a ceiling, call it, where we feel price was going to bounce off from and reverse. And so here we draw our supply from a key point, and then price came back, tap into the supply zone and dropped. So supply is always good in technical analysis, but it's far better when you combine it with other technical tools, other technical skills like the trend line. And so when you have it with the trend line, then it makes a lot of sense and then more sense. Another thing is the demand. Like I said, the demand is like the floor, is like the support where we feel price is going to come back, bounce from, and then go up. And so we have our demand drawn out like this, and price comes back, tap into it, and then moves up. Demand is very, very important in the market. Having your demand drawn well like this can gives you trade opportunity in the market. There is something that is very important that most people don't know when drawing supply and demand. There are two things you look out for when drawing supply and demand. First is fair value gaps, otherwise called imbalance. Now, fair value gaps are candlesticks that have gaps. For instance, these three candlesticks, we have candle 1, candle 2, candle 3. The space between this candle 1 and candle 3 here is what we call fair value gap. So this space now is what we call imbalance, fair value gap. Now, normally price will come back to fill this fair value gap. And so to have a valid supply zone, you must always draw it from a point where there is a fair value gap. Like here, we have candlestick 1, candlestick 2, candlestick 3. This gap here is what we know as fair value gap or imbalance. And normally price will always come back to fill it. As we can see here, price came back, tap in, filling this fair value gap and drop. That's what added more confluence to this supply zone. That's what made us know that price was going to drop. As a matter of fact, I dropped this signal in our free Telegram channel because I was very sure that price was going to drop down. And so I had this marked out. And so you see, price came back to fill the fair value gap and then tap into the supply zone and then drop. Now, another thing about supply zone that is very, very important is that supply zone, drawing it from other block, is always very, very important. Other blocks are points of accumulation of prices order left behind by big financial institutions. So like here, we have price came back, drawn from this other block, fill this fair value gap, tap into the other block, and then drop. The same thing applicable to the demand zone. This is drawn from other block, and so we have price dropped back, fill the fair value gap here. You see the fair value gap here, and then tap into the other block and then went high up. And so it's very important to draw your supply or demand zone from an order block and at points where we have fair value gap, which is always shown by momentum candlestick like this, or yeah, momentum candlestick, a long candlestick that has a lot of buying or selling pressure or selling momentum, like all these long candlestick always form fake value gaps. Another thing that is very important that any trader should know out there is support and resistance. Remember, understanding the basics of this technical analysis will help you to harness, will help you to understand what's going on in the market and can help you to build your own strategy in the financial market. And so, as you can see here, this is a support. Like I said, support is like a floor where we know that price was going to bounce off many times. Like here, we have price bounce up here, came back and bounced off here again, came back the third time and bounced off here again and go. So this support is respected many, many times. So it's a point where like a psychological number where we know price is always going to be rejected or price is always going to bounce off from. While resistance, on the other hand, is like a ceiling, it's like a top, a roof where we know that price will not exceed. And so we have here price rejected here, came back, tap into it again, dropped, tap into it again, third time dropping, showing that it's a strong point, it's a key level, it's a point that is very, very respected in the market. And so you can base your technical on this. So you can have your trade, your sales opportunity at the resistance or your buy at the support level. Another thing that is very important that most trader needs to be used to is chart patterns. Chart patterns in the market. Chart patterns are very, very important in the market because the formation of this chart pattern always help us take trades easily without having to analyze too much. Such of those chart pattern, one is the head and shoulder pattern. The head and shoulder pattern is a trend reversal pattern that occurs in an uptrend and signifies a change in direction from uptrend to a downtrend. So we have price was trending up from the left shoulder, came back from the head, and then the right shoulder. And then we have here the neckline. Now the neckline is like a support level. To validate this structure, we have to wait for price to break through the neckline. That's when we know that the structure of the market is going to change. Now, looking at it from the price action standpoint, you see that price was trending higher highs, higher lows, higher highs, higher lows, higher highs, and then broke structure. So when price broke structure, we know that the trend of the market has changed and is changing to downtrend, and we start looking for sales opportunity. And so understanding these patterns in the market is very important. So if you get on the chart and you see something like this, it's very easy. You know that you're looking for sales opportunity. And since you're looking for sales opportunity, it means that price is changing direction from uptrend to downtrend. And then you just flow with it. And so when you take the sell, it's always nice. You have your stop loss at the level of the right shoulder above, and then you can target as far as from the head to the neckline again. That's the pip count. So you count from the pip from the head to the neckline and then measure it from this point. That will be your target. That's how to trade the head and shoulder pattern. The head and shoulder pattern is one of the most reliable price action chart pattern in the financial market. Another pattern we have is the rectangles. The rectangles is just made of the support and resistance. And so all we just want to wait for is for price to break out of this box. And so the moment price breaks out of this box, we know that, okay, we're going to take a buy up or a sell down. It shows that price is ready to move in either direction. And so these rectangles was formed as a result of buyers and sellers taking a pause from the market. It could have been a downtrend or uptrend market. Maybe after a London session, traders, the big financial institutions, most of their workers, most of the traders decided to take a pause off the market and then grab some coffee, take a break, and then they came back in the New York session. So this may have caused the ranges. And after that, we just wait for price to break out of this box and then we trade in line with the new trend. Another thing that is very important, another chart pattern is a symmetrical triangle. So this happens, price was trending up, and then still maybe they grab a cup of coffee, they went to take a break and price started ranging. All we just have to do is so wait and then draw the symmetrical triangle, wait for price to break out of it. And so the moment price broke out of this symmetrical triangle, we knew okay, the uptrend market is about to kick off and then we should trade in line with it. And so the best place to always have your entry at is this point, and then your stop loss just below the symmetrical triangle and flow in line with the new trend. This is very, very reliable in the financial market. Another thing that is very worthy of note is the double top and double bottom pattern. This is the double bottom pattern. It's just two projections down. Also, a trend reversal pattern that signifies the change in direction from downtrend to uptrend. And it's shown by forming two projection downward. And so we see price was trending down with more of bearish candlestick. Price came back, came down, formed the first projection here, came back and formed the second projection, and then reversed up. And so the moment price broke through this trend line, this neckline here, we know that the trend of the market has changed, and then we should start looking for uptrend market. And so what happens? Price started going up. How do we know that price was going to go up? Because looking at it from the price action standpoint, this is lower low, lower highs. Lower low, price broke the previous lower high point. And so the moment price broke the previous lower high point, we confirm that price is now trending uptrend, and then we should be looking for buy opportunities. Another thing that is very important is the break and retest strategy, break and retest entry. And so we have three kinds of break and retest. We have the trend line break and retest, we have the support and resistance break and retest, and we have the structure break and retest. So this is a classical example of a trend line break and retest. What this means is that price was trending and respecting trend line in a very nice way, but at some point sellers started coming to the market, then the trend line was distorted around here, came back, tested it many times, but came back fully to tap into it the last time and then drop. So most traders, what they do is that they just wait for price to break out of this trend line, come back to retest it, and then they get into their sell and then flow with the new trend. Another kind of break and retest, which is also an example that was shown in the structure, is a structural break and retest. Price was forming lower lows and lower highs, lower lows and lower highs, lower lows and lower highs, then broke the previous lower high point, came back to retest it, confirming the direction that it's going now, that it's valid, and then started going in the direction. So break and retest is very important. In short, as a matter of fact, most traders rely on this break and retest strategy alone. Now we enter candlestick patterns. Candlestick patterns are very, very, very important in the market. Candlestick patterns carries a lot of message. So first we look at the hammer candlestick. The hammer candlestick shows that in a downtrend market, price is now ready to start going uptrend by showing what? A rejection, a weak rejection towards the prevailing trend, and then started going up in the opposite direction. So this hammer candlestick is a very reliable candlestick pattern in the financial market. Why? Because it carries two messages: a change in trend and an entry confirmation. So once you see this on a support level or a demand zone or on a trend line, it signifies a change, and then you should be ready to flow with the direction of the market. Why? Because we have the wick rejecting the current price and the body being full, showing that it's ready to move in the direction of the new trend. Another candlestick that is very important is the morning star candlestick. The morning star candlestick has three candlesticks. The bearish candlestick, which shows the downtrend that was coming. Remember, these candlestick patterns occurs at a trend change point where the trend of the market is about to change. It signifies a change in trend. And so this morning star happened in a downtrend market, signifying a change in trend from downtrend to uptrend. And so what we have here is the bearish candlestick first, a doji which shows indecision, buyers and sellers dragging, but nobody won. And then a bullish candlestick which completely engulfs the previous candlestick pattern, which is the bearish candlestick, showing that buyers are fully in control in this market and are ready to push price to the opposite side. And so the morning star candlestick signifies a change in trend to the next trend. Another candlestick that is very important is the shooting star, which is just the opposite of the hammer candlestick. It occurs in an uptrend market and signifies a change in direction from uptrend to downtrend. And most importantly, when it occurs on a key level like a support, like a resistance or supply zone or a trend line, or on a trend line, it shows that the trend of the market is ready to change, and then you should be ready to push price downward. This week here shows a rejection of the current price, and the price is ready to drop down to the new trend. Another candlestick that is very important is the bullish engulfing candlestick pattern. The bullish engulfing candlestick pattern signifies that the trend of the market is ready to change from downtrend to uptrend. The bearish share shows the trend that was before, and the bullish share shows the new trend that is going to before. And so when this occurs on a key level, like I said, it's always very important that we take note of them. Another candlestick pattern is the evening star, which is opposite of the morning star. Now, if it occurs on a key level in an uptrend market, it signifies a change in trend. Remember, we have the bullish candlestick, which shows the current trend, then the doji showing indecision, and the bearish candlestick, which engulfs the bullish candlestick, shows that price is ready to drop down to the new trend, and then you see price dropping to the new trend. So this signifies a sell opportunity. Another candlestick that is very important is the bearish engulfing candlestick, which is opposite of the bullish engulfing candlestick. And so when this occurs on a key level also, it shows that price is ready to drop, to change direction from uptrend to downtrend. And so the bearish engulfing candlestick occurs mostly in a downtrend market. So that's all on technical analysis. For you to be very good in technical analysis, you have to understand these basic things, which is very, very important in the market. You have to have them at your fingertips, be used to them, because they can present themselves in the market at any time. You should know what you should do with them when you see them. Thank you for watching, and see you in our next episode.